Welcome back to the Retirement Fiduciary Podcast, your classroom for no BS financial education. A place where we have authentic discussions about retirement planning, investment management, tax reduction strategies, insurance estate planning, and more. Here's your host, Adam Koos, President, Portfolio Manager, and Senior Financial Advisor at Libertas Wealth Management Group.
What's going on, everybody? Thank you so much for joining us today. As always, let's get started with a few housekeeping items. If this is your first time listening or watching, thank you so much for joining us. The Retirement Fiduciary Podcast is an authentic educational show aimed at providing honest, candid, fiduciary-driven insights for individuals and couples all over the country. The podcast is produced bi-weekly in the off weeks of our sister podcast, which is aimed exclusively at business owners. That podcast is called Elevate Your Business. So if you're an entrepreneur looking for top-tier business and finance advice, be sure to look it up and subscribe on YouTube, Apple Podcasts, and Spotify. And again, that's called Elevate Your Business or Elevate Your Business Podcast. As for the Retirement Fiduciary Podcast, we cut through the noise to deliver no-nonsense advice and expert knowledge to help you make work optional someday and live the lifestyle you've always wanted. So again, be sure to subscribe on YouTube, Apple Podcasts, and Spotify. And you can also find more shorts on TikTok, Instagram, and YouTube as well. In addition to the channels already mentioned, you can always find us on Twitter, or X as they call it now, at Libertas WM. That's our company handle. You can also follow me at Adam Koos. That's Adam Koos. I'm also on Instagram at Adam D Koos. And we're going to be adding a Retirement Fiduciary as well as an Elevate Instagram at some point here. Actually, Elevate already has an Instagram. It's the Retirement Fiduciary that we're looking to add. And then TikTok has a Retirement Fiduciary handle, which is just the Retirement Fidu. In other words, we ran out of characters. So, of course, the best place to go to get more videos, articles, podcasts, screencasts, links, visuals, charts, and other educational resources is always at libertaswealth.com. And again, if you're an entrepreneur, check out elevateandexit.com. All right. Today's episode is a part one. In other words, we're going to do this in a couple different parts because there's a lot of information. It's going to be a lot of fun. When people ask me what my why is, why it is that after almost 23 years now, I'm still doing this. We're still bringing new clients on board. We're still having a lot of fun. It's because we get the opportunity to save people. And when I say save people, don't get me wrong. There's lots of great financial advisors out there. There's lots of great insurance agents. There's lots of wonderful, ethical attorneys and CPAs out there, obviously. But there are some bad apples out there, especially in the insurance and financial advisory world. And so what we're doing today is we're exposing the wolves of Wall Street. Again, this is just part one, and taking a peek behind the curtains as we unmask the dark side of investing and financial planning advice. So let's jump right into it here. First and foremost, I always like to start with a quote, and today's quote is from Martha Beck. She's an author, life coach, and speaker, and her quote is, "How you do anything is how you do everything." And I think the reason why that applies today is because if you do anything, in my opinion, unethically, if you ever make a decision that you wouldn't want in tomorrow's front page, then I don't want to say that's how you do everything, but I know I wouldn't trust somebody if that's how they live their life. So let's jump into the material. In fact, actually, before I do that, because we're not going to have a lot of details here, I'm just going to go over a few topics. And then, like I said, we'll cut it in half today and we'll do the second part here in a couple weeks. But the reason I'm doing this podcast is actually it was a special request. We had a client, or have a client, I should say, who emailed me one day and said, "You know what? You ought to go out there and try to find all the bad advice, all the things that are happening, the dark side of investing, if you will, out there in the market, and kind of shed light on it and let people know what's going on." And if you're listening, you know who you are. So thank you for the recommendation. And I guess with that, if anybody ever has recommendations for these podcasts, we're all ears. And we're always looking for ideas. Usually we just come up with them on our own, but if you send us an idea, that makes our life even easier. And plus we get to record, educate, and do exactly what it is you're looking to hear or looking to learn about. So the first topic we're to talk about today, and I kind of make a little joke here, South Park, is commissions. And as he says on South Park, or if he were to say this, he'd say commissions are bad. Okay. So, commissions are bad. I mean, it's one of the biggest problems with our industry. Everybody who starts in this business, unless they're very, very lucky or fortunate and get to start with a fiduciary financial advisory firm, usually has this conflict of interest when they get started until they put themselves on the fee only side of the fence or the fiduciary side of the fence, which many firms never do. Case in point, just looking at Central Ohio, for instance, there's only about 25 to 30, intermediate size or larger financial advisory firms that are true fiduciaries. In other words, NAPFA registered fiduciaries. That's the National Association for Personal Financial Advisors. So there's just not a lot of fiduciaries out there. And the commissions are the problem. And one of the biggest questions we hear all the time is, how are fiduciaries, held in check? What is it that enforces, I guess, the fiduciary law? And the answer to that question is simple, and I'll try not to repeat myself later when I go over this, but the answer is that when you convert your firm, when you own a financial advisory firm and you convert your firm to a true fee-only NAPFA registered fiduciary, you're not allowed to have any life insurance, health insurance, long-term care, variable annuity licenses. You have to drop them. And you're not allowed to have any brokerage licenses. So when I converted our firm at Libertas to a fee-only financial advisory firm, a fee-only fiduciary, I had to drop my Series 7 license, Series 63, Series 31, Series 24. I had to drop my life, health, variable annuity, and insurance licenses. And I have to be honest with you, it was the way it works is they expire on your birthday after 2 years. And it was a terrifying day. Or I shouldn't say terrifying, but I was, it was an interesting day because I'm sitting here thinking about all the time I spent studying for these exams and all the stress and from studying to passing them. And if you've ever taken a really, really difficult exam, which I'm sure many of you listening or watching right now have, whether that be a financial exam or the MCATs, something for grad school, the bar, if you're an attorney, hitting that submit button, it feels like hours before they actually give you the results. And that's if you give the results. So like, for instance, the CFP exam, back when I took it back in the 2000s, they didn't give you the result. They just, basically sent you home. And then somewhere in the ballpark of 45 days later, you get a letter in the mail. And then your heart races as you open this letter and hope it says you passed. But anyway, I digress. So the problem with our industry is that commissions create conflicts of interest. And when you're a fiduciary, when you're a NAPFA registered fiduciary, you're legally not allowed to have any brokerage or insurance license, which means legally you cannot charge a commission. So what that means is, and again, I'll probably repeat myself later here, but what that means is that it doesn't matter whether we implement a financial plan for a client and through that implementation process, invest all of their money in large cap stocks, which we wouldn't, by the way, but let's just say we could. And if that was the best place to be in the world was large cap stocks, or if the best place in the world to be was the Australian dollar, which again, we wouldn't do that, but let's just say that's what made sense. Well, we get paid exactly the same. It doesn't make any bit of difference with fiduciary firms, true fiduciaries, where they have your money invested. It's when you start getting into different types of accounts that have big commissions, different types of products, investment products like annuities, insurance products, even stocks. I know there's still traders out there using commissions to buy and sell stocks. Believe it or not, I know it's kind of a dinosaur thing to do, but that's a good segue. So the next thing to talk about here, which you don't see a whole lot anymore. And again, this is probably more the dinosaurs of the world. When I say dinosaurs, I mean the financial advisory firms or financial advisors of the world that are still trading stocks, trading mutual funds, trading ETFs, and charging a commission to buy and sell. I don't hear it a lot. At least none of my peers in the industry around the country, around the world, don't do this anymore. But when you do trade and you charge a commission to buy and or sell investments, one of the biggest risks, and this was a long time ago, it happened a lot, back in the early 2000s, 90s, the 80s, you get this thing called churning. And churning is essentially just when financial advisors or investors or investment professionals, when they make changes in your account just for the sake of generating a commission. In other words, if they have an investment in your account and they say, hey, I'm going to make this change, I'm going to sell this investment and buy this other investment, and it isn't totally necessary to do so. The churning aspect of it is they're selling that investment not because it's so bad, and they're not buying the new investment because it's so much better, but more so they're doing it because they're just generating commission or generating revenue, which is called churning by definition. Now, this does still happen a lot, unfortunately. In the insurance world, we get a lot of what we call moving annuities. That's the word that gets used a lot. So air quotes here, moving annuities from one place to another. Often I've heard people say, clients come in and say that their financial advisor or insurance agent said something like, hey, your annuity is maturing, so it's time to buy a new one. I mean, if you own an annuity, the chances are it's not maturing, and you can continue to own it after the surrender period is over. The surrender period is the penalty period, by the way. So if you have a 5-year penalty, 7-year period, or a 7-year penalty, 10-year penalty, whatever the penalty period is, you can hold that beyond the 10-year period. You don't have to buy another annuity in 99% of cases. But what ends up happening is people will say, hey, your annuity's up, it's coming due, or it's maturing. And then what that does is it gives them an opportunity to sell that annuity, transfer it to another one now that it doesn't have a penalty, and they can earn another commission, which obviously they get paid a commission and you don't see that commission. It gets paid to them by the insurance companies. So there's another kind of pet peeve that I have in the industry where people will say, and I know there's a couple people right here in Central Ohio that I've heard from other clients that say this at seminars and things like that. They'll say, well, there are no fees. I don't know if you've ever been to a city like Louisville, for instance. In Louisville, there's a lot of insurance companies there. And let me just tell you, they're not working for charity. The lights are on, the water's running, the employees are wearing clothes. In fact, the buildings are made of marble. I mean, these companies are not struggling. Let's just put it that way. And so when I hear a financial advisor through the grapevine say something like, oh, there's no fees, it's just like, oh, come on, you got to be kidding me. And it surprises me that anybody can be so passionately dishonest, for a lack of a better phrase or better word, that they can actually convince somebody in the public to believe there is no cost, period. There's always a cost, right? There's always a fee somewhere. And in many cases, there's lots of fees, there's lots of different parties getting paid. So back to kind of churning here, it's when you're making an annuity that's coming out of surrender and you sell it, and then you buy another one. Another pet peeve, here's another thing that happens again a lot in the annuity world, unfortunately, is the annuity. I just heard, actually, somebody just said this to me 2 days ago at lunch. I was meeting with somebody who told me that and this is a professional, by the way. This isn't a client or a prospective client or an investor. This is a professional in the industry who heard an attorney who heard that they were somebody else, another professional who I'll leave unnamed, was taking annuities that had, say, an 8% penalty on them still, and then selling those annuities, charging the client an 8% penalty to get out of them, under the premise that the new annuity has a 10% upfront bonus, so the net gain to the client is 2%. And again, what's happening there is the advisor, attorney, or an insurance agent, whoever is selling this thing is making another commission. That's the bottom line. And again, and another thing to keep in mind is the reason these penalties exist are for one of two reasons. About 5 to 10% of the time, the penalties exist because a rate is really good. Let's just say, like, there's these days with rates being so high, there's equity indexed annuities that have really great rates, and as a result, they have to have a penalty on them because they need to have some time to generate these kinds of rates. Really, really good rates. But that's a minority of the time. The majority of the time, the reason why there's penalties to get out of investments like this, annuities in particular, insurance is the same thing, life insurance policies, is because the advisor or insurance agent that sold it to you earned a commission, and the insurance company needs to recoup that commission. Otherwise, they lose money if you sold it. So they have to have a penalty. And of course, if you sell it early, that commission gets recouped out of your pocket, not the advisor's pocket, not the insurance agent's pocket. So this whole concept of taking an annuity that has a penalty on it still, and a tiny penalty, okay, maybe you could justify making a change, 1-2%, maybe 3%, but 5%, 6%, 8%. If you're unloading an annuity and then saying, well, I've got a bonus over here that's going to pay you 10, you aren't looking at the internal costs of it. And it's not your fault, by the way, if you're an investor and you're listening to this or watching this, because there's professionals out there are supposed to be trusted. They're supposed to be trustworthy. And that's why you're trusting them, is to take care of this stuff for you, just like you would trust a doctor to diagnose you correctly and to do surgery and perform it well and efficiently, and not make mistakes. So that's, I think I could probably go on and on here, but I've already spent enough time on churning. So let's move on. And this gets interesting because there's this next thing called reverse churning. And this is really, really interesting. I haven't heard the phrase in a while, it hasn't come up. But reverse churning is the exact opposite of churning, obviously. It kind of feels stupid saying that out loud because obviously it's the opposite. It's called reverse churning, right? But here's what reverse churning is. If you understand that churning is essentially buying and selling investments for the sake of generating revenue, reverse churning is something that started happening in the early to mid 2000s, and then it became kind of a problem in the late 2000s and 2010s. It's when somebody takes them out of brokerage accounts, like typical commissionable brokerage accounts, puts them into fee-based accounts, or wrap accounts as they're called. And when they put them into the wrap account, now you're paying an annual percentage of assets under management, and there's technically no commissions anymore. You don't have to pay commissions. There might be ticket charges, transaction fees, SEC fees, something like that, something very small to buy or sell, let's just say, but you're just paying a percentage of assets under management. And then reverse churning is the act of not placing enough trades. So in other words, it's what they were looking out for, the regulators, was they were looking out for financial advisors and wealth managers that basically went from buying and selling and buying and selling and buying and selling investments for the sake of generating revenue, not because it was good for the client. And then with annuities, selling annuities, buying new ones, selling annuities, buying new ones, to putting all these investments into a wrapper that pays them, let's just say 1.5%, 1.75% per year, whatever the case might be, and then not making any changes at all because they're getting paid anyway. So that's reverse churning. It's essentially putting the money into an account and just kind of letting it sit there, not making changes, or at least not making enough changes. Because I will say that the one caveat, there is a lot to be said for not making too many changes. I think that there's a such thing as excessively trading, even if you're in a wrap account. In other words, even if you're paying an assets under management fee, which is primarily what we do at our office, there is a lot to be said for not placing lots of trades and placing lots of buys and sells to make lots of changes all the time. I think that it all depends on your time frame, and I don't want to go off the rails here and turn this into a different discussion about portfolio management, because that's not what we're doing today. But whatever your time frame is, whether that's and most clients, by the way, most investors, their time frame is not short term. They're not swing traders. So our time frame at our office is intermediate term when it comes to our trend following portfolios, and then probably intermediate to long term when it comes to our static strategic models that we manage. So change is good, but enough change and not too much, if that makes sense. And of course, if you have questions about cutting through the details there, if you have questions about your accounts with your financial advisor, your portfolio manager, and you're wondering, is enough change being made in my account, or is too much change being made in my account? I'd be happy to learn a little bit more about you, your situation, look at your portfolio, kind of understand what's going on in your life in terms of your wealth management, and kind of give my opinion. Whether we work together or not, I'm happy to share. So that's reverse churning. If you have any questions, let me know. The next, I would say, issue in the industry, or dark side of Wall Street, as we're saying here, the dark side of investing, would be missold insurance policies. This is one of those situations where you go to an insurance company. I don't want to pick on any company names because I don't want to get sued here. But there's a few big insurance companies here in Central Ohio, and I'm sure that if you just think about it, think of some big names in the insurance industry. They're not typically going to do any kind of financial planning. In fact, it is highly unlikely that they do any kind of solutions-based advice, provide any solutions-based advice, provide any financial planning advice. They might do something with mutual funds, maybe here and there, maybe even ETFs. I mean, I haven't seen it yet from an insurance company. In other words, when clients transfer their accounts to us and they hire us, I don't really see, when it's in an insurance company, ETFs. Never see individual stocks ever at an insurance company. What I typically see is mostly insurance policies, annuities, and then occasionally some mutual funds, and that's about it. And we don't even use mutual funds at our office. But again, that's another discussion for another day. So when you're looking at insurance policies and you're at an insurance company, that's what they're going to put your money into. Is they're typically going to use insurance, or they're going to start with insurance or lead with insurance of some sort. Whether that's fixed annuities, fixed indexed annuities, equity indexed annuities, variable annuities, universal life insurance, whole life insurance. So everything's going to be insurance based. And I'm not even picking on them, honestly, because, if you work at a place like Midas, like up in Cleveland, there were a lot of Midases when I was growing up. They help you out with mufflers. You want a muffler, go to Midas. I mean, that's what you're going to do. And so you can't be upset at them, because that's what they do best is mufflers. And maybe these insurance companies would argue that's what we do best. We do best at selling insurance, life insurance. We do best at, with our annuity products. I think the problem comes when you go someplace like that and you're looking for holistic advice, you're looking for big picture solutions to your long-term wealth management needs during your accumulation phase of your life, which is while you're still working, and then your distribution phase of life, which is when you need retirement income planning. And when I say retirement income planning, I don't mind buying annuity and taking income out of it. That's exactly the opposite of what I'm suggesting. So it needs to be big picture advice for things like not only retirement and retirement income planning, but investment management, where you're not just looking at insurance and annuities, but looking at all kinds of investments. I think you need to look at tax planning. I think you need to look at insurance planning is important, but not just life insurance and annuities, but home and auto insurance, liability umbrellas, long-term care insurance, disability insurance, health insurance. So there's so many types of insurance that it's a necessary evil, but it's something we have to pay attention to. And then of course estate planning. Trust, wills, powers of attorney, healthcare directives. If you have kids with special needs, autistic kids, like I have an autistic nephew, special needs trusts are crucial. So if you're looking for holistic advice, you're probably not going to find it at an insurance company. And instead, what you're going to get is a lot of annuities. You're going to get sold probably a lot of insurance that's really, really, really expensive. I'll give you two more examples. So whole life insurance. I have yet to find anybody, even an insurance agent, that can tell me or prove to me why it is that whole life insurance makes more sense than any number of other alternatives, other than it pays a big commission. So if you're an insurance agent out there and you're listening or watching this and this is pissing you off, give me a call, shoot me an email, prove me wrong. I would love to be proved wrong because maybe I'll learn something. I'm not trying to beat anybody up here. Easy for me to say. And then the second thing are something called life insurance retirement plans, which are just kind of like an acronym or like an easy way to remember. Basically, an overfunded life insurance policy. It's basically flipping it upside down. Another acronym or name I've heard is an ELIP. ELIP stands for Executive Life Insurance Plan. So Life Insurance Retirement Plan, or LIRP, or ELIP, which is Executive Life Insurance Plan. What they do here is instead of buying as much death benefit with a permanent life insurance policy for as little cash value as possible, which is what most people do when they buy insurance, they're trying to get as much death benefit as they can. What we do here, or not say we, because we don't have insurance licenses, but what they do, or what the purpose of the strategy is, and it is a good strategy for the right people for some of your money. But what the strategy is you want to overfund the policy by instead reducing the cost of the internal insurance cost, and then instead overfund the cash value, which provides more money into the investments, so the investments can grow long term, and then those investments can be borrowed against later in life, tax free, a lot like a Roth IRA. The problem with them, and the reason why I believe they're missold many times, is because I don't think you should invest in a life insurance retirement plan or an executive life insurance plan until after you've already maxed out your 401k at work, until after you're already maxing out, say, Roth IRAs if you're eligible, if you don't make too much money, if your income limits aren't too high, until after you've got money in emergency savings, until after maybe you're putting money on a systematic basis into a brokerage account, like a joint investment account that's liquid that you can use anytime. Whereas, an insurance policy is going to have like 10 to 12 years of penalties, and you're not going to be able to borrow against it for much later down the road. You got to leave it there for 10 to 15 years minimum in order to make this thing work. So I think that overfunded life insurance or LIRPs or ELIPs, I think that they're great investments for some people, for some of your money. But I think that the probability of them being right for you is probably extremely small, unless you're doing a whole lot of other saving first. In other words, there's other better, cheaper ways to invest than to use life insurance as one of your first, or one of your first options. The next one here I'll share is I'm only going to tell one quick story. Actually, I'm going to tell two stories about what I'll call creative Ponzi schemes. And the reason I call them creative is because when you hear the phrase Ponzi scheme, most people just kind of laugh. If you know what it is, you think, oh God, that's ridiculous. I can't believe that anybody would fall for that. But the reason I call them creative Ponzi schemes is because there are some out there. I'm still seeing it, not often. I would say once every 2 or 3 years, we have a new client come into our office who's been scammed. And the rate, usually the terms, what I hear from them is not believable to me, but the person who sold them the investment was believable. They were trustworthy, or at least they seemed like they were trustworthy. So here are two stories. The first one was a long, long time ago. Unfortunately, this client of ours passed away. She was one of my first clients back in 2001 when I was going uphill both ways in the snow. 60 pounds lighter. I looked like I was 16, and I was trying to convince people 3 times my age to trust me with their life savings. So, but she was one of the early people who trusted me. And she went to a seminar with a friend. And when she finished the seminar up, the person giving the presentation said, hey, would you like to set up an appointment? And she said, no, I'm not interested. And but he had her contact information. And she was, at the time, she was probably like 76, 78 years of age. Never married, never had kids, and just, a wonderful person, extremely active in her church, at the church 3-4 times a week. And just really, really a wonderful person. Took care of her dad till he passed, then took care of her mom until she passed, helped her sisters until they passed. So anyway, so this guy who was an insurance agent, he said he was a financial advisor, but he was an insurance agent. One day gives her a call and says, hey, I'm in the neighborhood and I just wanted to stop by and show you about these other investments, these 2 investments that I've been showing other people in your area. And she, the guy, to use her words, she said, he was really nice. He was really sweet. He was Catholic like me. And he had girls that were in Catholic schools. So she let him come over, and she sat down at her kitchen table with him, and he basically told her about these 2 investments, both of which were annuities, by the way. And she said she wasn't interested, but thanked him for his time. And before he left, he asked, hey, can I get a glass of water? And so she says, sure, yeah, of course. And she leaves her kitchen table and goes into the kitchen, which was technically a separate room. A lot of these days kitchens or kitchen tables are in the same room as the kitchen. Well, this was an older house down in Grandview, Ohio. And she walks in the kitchen, she gets him a drink, comes back in, he takes a few sips, and they part ways, and that's it. Well, I'm kind of telling you the story backwards because I didn't find out about this story until after I got a phone call back from one of her annuities. She had actually a prior financial advisor who, this is going to sound like I didn't remember this part of the story, but her prior financial advisor before she hired us was somebody she felt bad for. It was a financial advisor who was a single mom. She was divorced, but a devout Catholic, had all 3 of her kids in Catholic school. So she had transferred all of her assets to us from that financial advisor, but that advisor had put her in 3 different annuities. That was the majority of her assets were, somewhere in the ballpark of $1 million in 3 different annuities. So anyway, so I'm placing a trade. Basically, I'm reaching out to one of the annuity companies to make an investment change, and I place the trade and I hang up the phone, and then I get a call back from the annuity company maybe 30 minutes later or so, and they say, hey, I'm confused. I've got your trades here that you've asked me to place, but then I also have an order to liquidate the policy and transfer it. So do you still want me to place the trades, or do you just want me to liquidate it if you're transferring it anyway? And I'm like, wait a minute, I'm not transferring the policy. We're not liquidating it. At least I didn't think we were liquidating it. If we were liquidating it, I didn't know anything about it. So I said, let me give the client a call and I'll call you back. So I hang up the phone with this person at the service center, and I call the client and I said, hey, did you call and liquidate your annuity, or did you talk to anybody? And she proceeds to tell me this whole story that I just told you. And what we figured out as we're literally on the phone, she starts looking through her statements and she realizes that while she went to get this guy a glass of water, he stole her statements. And then she also mentioned that he gave her a yellow legal pad, like a lined yellow legal pad, and said he put 2 X's on the paper, one on the top of the document, one on the bottom. And it wasn't a document, it was just blank paper. And he said, if you sign here at these 2 spots, I'll at least be able to guarantee a rate for you, or guarantee the rate that I'm guaranteeing everybody else. Now, that made no sense whatsoever. And I feel so bad for her. And I don't know why she signed it, because obviously you never sign something that isn't an actual document. But she signed it in both places, even though he literally just drew an X and a line on a legal pad. And then he stole her statements. He forged her signatures on all the transfer paperwork, and was transferring all 3 of her annuities into another annuity to make what would have been around a $70,000 commission. So I was so infuriated. I actually called him. I called the guy, and the phone call, as you could probably imagine, didn't go so well. But he reverted to saying that she has, she's old and she's, losing her memory and she's not remembering things correctly, which infuriated me even more because that was not the case. She was extremely sharp, 0 issues with memory. And at the end of the day, we really couldn't do anything other than cancel the transfers. So while it's not necessarily a Ponzi scheme, it's definitely a story of somebody trying to take advantage of someone because they're kind, they're trusting, and they believe people are good. And unfortunately, there's people out there in the world who aren't, that kind of make things bad for everybody out there. But there's no shortage of those people. And I guess that's what we started with today, is that there are a lot of bad apples out there. And at Libertas anyway, one of our missions is to save people from advice like that, or save people, I don't even want to call it advice, but to save people from being scammed like that. So, and to put them in the right portfolios that are based on a written, comprehensive financial plan with solutions-based, fiduciary-driven advice. But I digress because I'm really getting on a soapbox here. But this is a solo cast, right? I'm not interviewing anybody, so all you guys get to do is listen to my voice and hear me talk. But the other story, which is much shorter, that I'll share with you, and this actually was a Ponzi scheme. We had a new client come into the office probably 4 or 5 years ago, maybe 6 years ago, because it was before COVID. And they transferred all their assets over, but they had this one investment we couldn't transfer because they couldn't find statements. And the statements they had were literally these weird documents that looked like they'd been printed on, an inkjet printer using Microsoft Word. And when they explained how the investment worked, they said that they'd bought it from a guy who sold him the investment. It was a bond, and the bond matured annually, and it was paying 11.5%. And what's funny about that is this was 5-6 years ago when interest rates were literally a zero. I mean, the Fed funds rate was zero. So if they would have told me it was 8%, I wouldn't have believed them. But when they said 11.5, I had two thoughts. I thought, first, there's no way. There's something wrong here. And then the second thing I thought was, I hope they asked questions before they just pulled the trigger and bought this thing, because that is way too good to be true, especially in that interest rate environment. Even this interest rate environment that we're living in now, and interest rates are much higher now than they were before, and it's extremely unlikely you would find a bond, a 1-year bond paying 11.5%. That's insane. I mean, it's just that, or asinine is probably a better word. But anyway, when we went to try and liquidate it, the guy said that he couldn't liquidate it right away. He needed some time. And then this client, it turned out they had a friend that referred him to this guy, and they talked to the friend, and the friend said that they had the same issue trying to liquidate it, and that it took some time, and then they weren't able to get their money back. And so as we did more research, we found out that there was no investment. There was no bond. It was literally a guy. It was a Ponzi scheme. It was a guy taking money from people just like Bernie Madoff, putting it in his own account, sending out statements that said that they were earning 11.5%, crediting that interest on paper to an account that he literally, drafted with a Microsoft Word document. And then when they needed money, he just used new deposits from new clients to give the money back to old clients that wanted the money. If they wanted income or a partial distribution, he would just take new money in and give them that money, assuming he hadn't spent it already. So eventually what happens is, the money runs out, and when there's no investment, and the whole thing blows up. So I don't know whatever happened there, because at the end of the day, they ended up getting so freaked out, these two clients, that they didn't end up working with us. I think maybe I came on too hard. I don't know. But like I said, I get pretty passionate about this stuff when people are being taken advantage of, and I probably get, I probably get too passionate, too animated. And who knows, maybe I scared them away. But bottom line, I don't know whatever happened. I know that they had a hard time getting the money back. And, to this day, I ought to look them up and maybe reach out to them now that I'm talking about this story. But maybe I can find them and see how things went, and maybe we can revisit that relationship. But anyway, that's Ponzi schemes. The last one I want to talk about today, and we're going to cut, and we'll have a part 2, like I said, and we'll talk about some more new strategies. Strategies. What am I talking about? That's when you're just talking and trying to fill dead air, is when you say something like strategies. But anyway, we're going to cut here. We're going to go to a part 2, which will come out in 2 weeks. And next time we're going to talk about some other myths, some other dangers that are out there, some other, wolves of Wall Street, the dark side of investing. We'll have a bunch more, probably just as many as we had today. But the last one we're going to talk about today are proprietary investments and or insurance products. And I didn't necessarily need to put insurance products in here, but some of these proprietary investments are insurance products as well. So I just wanted to share that. So an example of a proprietary investment would be there are, I got to be really careful because I don't want to use company names. There are brokerage firms out there that used to have investments that were the same name as their company. And then investors started realizing or started figuring out that they were basically selling their own investments, which wasn't illegal by any stretch of the imagination, but it was, well, they earned more money because it was their investment, as opposed to, let's just say you're buying an annuity, because again, we're talking insurance products are part of the mix here. If you buy an annuity and that annuity is, an annuity owned or managed by another company, then obviously that company makes some money, and then you might make that the company who is holding the asset might make some money as well, but generally not nearly as much, right? Now, if you're a brokerage firm and then you also own annuities that you can sell to clients, and you're offering your clients your own annuities, then you keep all the revenue. So again, kind of a conflict of interest, not kind of, but definitely a conflict of interest. And there were definitely companies out there, still companies to this day, that had proprietary investments like this, except they've changed the names. So you wouldn't know today that, well, unless you knew the history, unless you were in the industry, or unless you did the reading or like Googled it, that there are investments out there that don't look like they're proprietary by name, but they're actually owned by the same brokerage firm or financial advisory firm or bank that is actually the custodian or broker dealer in question. So be on the lookout for things like that. Same thing goes with mutual funds, ETFs, things like that. If you're working with a firm that also sells or issues their own mutual funds, I think that's a conflict of interest as well. So that's a little bit about proprietary investments, and I think I'll stop there. So next time what we're going to do is we're going to talk about insurance agents posing as wealth managers and what that means. I'll get into some detail there. Attorneys running side gigs as financial advisory firms, which doesn't happen a lot. It's very, very rare. But if you ask 100 attorneys, 99 attorneys will tell you that that's unethical and something you shouldn't do. So we're going to talk about that. Advisors that buy TV time or write what are called advertorials, which are basically articles they had to pay for to be in a newspaper. It basically looks like it's an article that they were interviewed in, or in the case of TV episodes, it looks like they're on the news when really it's not news at all. It's a paid program that they're paying to make it look like they're on the news. So it makes it's perceived as being more reputable, but really they're just paying for the time. We'll talk about that. And then we'll talk about designations, certifications that are maybe a little bit BS, and have a little bit of fun with that. And I'll give you some examples even. I'll give you some examples of designations that maybe aren't so reputable. And then we'll finish just kind of talking a little bit more about the fiduciary law, what that is, what it means to you and your family, why it's so important to hire a true fiduciary. And hopefully in the meantime, you've learned a little bit today. But we're going to go ahead and end there. So if you'd like to get a hold of us, as I mentioned earlier, our main office is in Columbus, Ohio. You can get a hold of us at info@libertaswealth.com. You can also just go to our website at libertaswealth.com if you'd like to get more information, learn more about us. If you'd like to get a second opinion on your portfolio, your financial plan. If you don't have a financial plan, by all means, reach out. We can set up an intro call. That's always the first step for any inquiry or any second opinion here at office. It always starts with a 30-minute intro call just to get to know each other and determine whether it even makes sense to move forward at all. Like I mentioned this at the beginning of the episode, we have our sister company, Elevate Your Business, or elevateandexit.com. It's all exclusively for business owners and entrepreneurs looking to sell their companies at someday. These are owners who are looking to increase enterprise value, increase their net worth, while at the same time getting more efficient, living a lifestyle that maybe is less busy, not working 70 hours a week. And then, of course, we're also for Elevate, we're also on YouTube, Instagram, and Twitter, but you can see those here on YouTube. If you're watching it, if you're listening on iTunes or Spotify, then we'll put all this in the podcast notes. So I'll go ahead and end there. I'm struggling with my words today. I apologize, but we're going to go ahead and end there for now. And please stay tuned, subscribe, and be on the lookout for our next episode, which is going to be part 2. Until next time.
Thank you for joining us on the Retirement Fiduciary Podcast. To see any charts or images that were mentioned on this show, to check out additional articles, videos, and other educational resources, or to set up an intro call with your host, Adam Koos, just head over to libertaswealth.com. This podcast is for informational and entertainment purposes only and should not be relied upon as a basis for investment decisions. None of our shows engage in rendering legal, financial, tax, or other professional services. Always talk to a certified financial planner or fee-only fiduciary financial advisor before implementing any of the ideas shared in this episode.